All right, with that, let's get you another end of the year conversation. And here's where we get you the thoughts and the ideas of people that manage your money. And I'm in conversation today with Shreyas Devalkar, who's a head of equity at Axis AMC. Shreyas, thanks so much for taking the time. And I think a lot of people are thinking about how to position themselves or how to set their expectations for the new year. Invariably, that's what happens. And as we end this year, it's not been the best for equity markets. It's, in fact, not been the best for fund managers and stock pickers as well. How would you describe 2025?
If you look at as far as 2025 is concerned, so 2025 actually it has been, as anticipated, a year of moderate returns, and that forecast has largely materialized. So Indian equities delivered muted return and single digit in what turned out to be a stellar year for global markets. And that's where we actually ended up underperforming the global market. But in my opinion, this drag was mainly because of reciprocal tariff imposed by US, and where India faced the steepest levies among affected nations. And elevated valuations along with the persistent foreign portfolio outflows, which also we witnessed, it added to the volatility. And domestic, obviously the inflows has been the savior this year. And in my opinion, the earnings cut cycle, which was there, we started somewhere in the mid of 2024, it continued till the part of 2025.
Yeah, ultimately all of this helps people understand what the year gone by has been, but then ultimately everybody wants to look forward and try to figure out what 2026 is going to look like. Is this Mandi going to get over is the question that a lot of people are asking. Shreyas, what do you think?
So 2026, the way I would look at it is as far as the valuations are concerned, both on, which has been one of the main reasons for underperformance, because after supreme returns, actually what we saw almost in 2022, 23, as well, that kind of return, your overall CAGR was running much ahead of the earning growth, and that's where there was a PE re-rating what we saw. So that had to correct as such, and that's where I would first start from. So underperformance of Indian equity compared to the emerging market, which it has led to now Indian equities valuation compared to emerging market at just one standard deviation above. Earlier it was much higher. Secondly, there has been a trade of AI beneficiary companies versus non-AI beneficiary, or someone who gets hurt. In that trade, generally in India, there were not many companies who could benefit from AI. And that's where again India was left out of that trade. So there are multiple indications worldwide that the focus is back to looking forward to whether AI investment is making money or not, whether the valuations are elevated, and many companies have corrected in that space as well. So in that sense, if that trade of pro AI start reversing, that also can be a good outcome for Indian equity. Just to give you a perspective here, that Nifty's P in 2022, late 2022, was closer to the Nasdaq P, and now Nifty's P is 24, while Nasdaq is at 36. So to the extent this trade happened, that gives you a perspective of that.
Yeah, it's fair. Speaking of valuations, relative valuations, and the large cap space in particular, Shreyas, ultimately over the last 1 year, broader markets have underperformed, relatively speaking. Large caps have actually been the ones that have done okay, even though it's nothing to write home about. But having said that, even at this point, you have the Nifty 50 as a percentage of overall market capitalization for the Indian stock market at pretty much the lowest ever, right? You have the top 10 odd stocks as a percentage of total market cap at the lowest ever. Is this an opportunity in your mind from the lens of how you approach portfolio selection? You've had a quality bent in the past.
So if you look at from the quality and growth point of view, what market has done is over last 3-4 years since 2021 to now, is that the companies and the sectors which has actually shown very high growth, or there is a promise of growth, there is a story, there is theme, such companies got re-rated a lot. If we compare the multiples pre-COVID versus now, in segments like capital goods, it is almost 96% higher multiple. Electric utility 67%, construction material 65%. A segment of pharma, especially CDMO, it is 45% higher. So these multiples are way higher. While there is a coming back to the large caps, so the segments which I highlighted are having representation more in mid and small cap. Now the segments which have more representation in large cap, which is private bank, consumer staple, IT services, PSU banks, consumer discretionary and auto, here the P re-rating is only up to the extent of 20% compared to the pre-COVID. So, but there is a reason. In most of these segments, the growth has been subdued in last 4-5 years. And that's where the market, the way we are investing, we are also looking at both approaches. One is valuation comfort, which is coming with a lower growth. So the part of portfolio which is mostly large cap oriented falls in this bucket. While there are growth companies, but they are coming with very, very high valuation. And that's where you are standing on a very high valuation risk. And that's where, from risk reward perspective, even now, in my opinion, the large cap, more because of the valuation comfort, looks favorable.
It looks favorable. So, but if you were to look at the market as a whole, and of course you manage schemes across the board, so therefore you would look at the broader markets as well. As you stand on the cusp of 2026, are you more confident than you were at the start of 2025 that there are more tailwinds than headwinds, and that you will return? See, a lot of projections are calling for what, 15% odd earnings growth in FY27. By that logic, one would assume that portfolios will also do dramatically well. We're moving past a year, Shreyas, where you had single-digit earnings growth.
Sure. The few things which I am looking forward to fundamentally here is, one is RBI's neutral stance, and it has actually given us a rate cut. The ample liquidity we have seen by RBI in this market. So that, coupled with fiscal measures like GST rationalization, tax cut, MSME support, and regulatory reform by both RBI and SEBI, all these things are actually the cornerstone for the structural growth story of India. So all the steps are in the right direction. That is one. Secondly, India's macroeconomic stability will be more driven by fiscal consolidation effort, the low oil prices, what you are seeing now. Every day you are looking at the lower oil prices, and the steady global growth. On the domestic consumption front, along with the GST and the fiscal stimulus, the point is that there is also rural recovery, which may be more driven by the agricultural activity. On the other hand, if there is a resolution of the tariff issues between US and India, that actually can accelerate recovery, and that can attract FII even faster. Today, valuation-wise, we are reasonable, but there should be some trigger for it, so that can actually attract FII even faster. In my opinion, as I highlighted earlier, the valuation definitely is in favor, especially the AI trade which has happened, the reversal of the same. And lastly, the earnings, which you pointed out to. This earning cut cycle, which started somewhere in the mid of 2024, that actually, in my opinion, lasted till 2025 end. Now, from here on, when you're expecting just single-digit growth, definitely on this low base, there is high probability that now the growth can be in mid-teens for next year. So that is also good news in terms of earning growth trajectory as such.
So are you going to end 2025 with a smile on your face, Shreyas? Smile of relief and smile of expectation?
In my opinion, yes, the nominal GDP growth, if it revives the way all the macros are stacking up, there is very high probability. And if it gets delivered, definitely we can see good returns.
Okay.
The only aspect, I always say that the expectation from the market should be nominal GDP growth plus minus few percentage points, and that should be the possibility.
And let's hope that nominal GDP goes back to double digits next year, Shreyas. On that note, thank you so much for taking the time. Pleasure speaking with you as always.
Thank you. match.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. Do stay tuned. This is NDTV Profit.